An annuity is traditionally the conversion of a lump sum into a guaranteed income. The lump sum is usually derived from your pension fund, and this then is converted into an income for life. Pension commencement lump sum is the name given to the tax-free cash that is usually available from a pension fund. Up to 25% of the said pension fund can be taken as tax-free cash to be spent as you so desire. Should you not wish to take the tax-free cash and use it to generate an income, it's essential that you take advice on the matter, because there are potentially other more tax-efficient means by which to do so. There are several different options available with regards to incomes from annuities. There's guarantee periods, single or joint, escalating or level. With regards to guarantee periods, this is whether an income will continue in the event of the annuitant dying. Many people consider annuities dead money, because if the annuitant dies relatively soon after purchasing the annuity, then effectively the insurance companies traditionally kept the money, whereas a guarantee period guarantees that the income will continue to be paid even on the death of the annuitant, usually for a period of 5 or 10 years. Annuities can also be joint or single. So this means that should an annuitant die, then an income will continue to be paid to the spouse. This has always been traditionally the way with final salary schemes, where there's widows' pensions built into these schemes on an ongoing basis. And the same can be done with an annuity purchase with a pension scheme, personal pension scheme. The last option is whether you have a level or escalating income. In an ideal world, one would want an escalating income to keep pace with inflation. However, most annuities are purchased on a level income basis because the difference in income is significant. So it's a good idea to get advice on this matter so that you can decide whether a level or an escalating income suits your circumstances better. There's two main factors that will determine the amount of income received from an annuity. One of them is gilt yields. The underlying investment vehicle used by most annuity companies are government gilts. The better the yield on the gilt, the better the annuity rate. When gilt yields are low, annuity rates unfortunately are low. The second major impact on the level of income that you can be received is health or mortality. Annuities are effectively insurance companies taking a gamble on how quickly they think you're going to die. Any health issues that you have, such as heart attacks, strokes, cancer, that will impact your life expectancy, will generally mean that the relevant insurance company will be more generous and be willing to pay out a higher level of income, possibly on the theory that they won't have to pay it out for as long a period of time. The income they will pay out will be greater. So it's important that you disclose all the necessary information to try and generate as much income as possible. By speaking to a qualified independent advisor, they can ask all the relevant medical questions to ensure that your income is maximised.